Nvidia stock is currently trading live at $211.29, down 1.66% in today's intraday trading session. While the broader market watches this minor daily pullback with a sense of calm, the underlying mechanics of this price action reveal a massive disconnect between expectations and reality that most retail investors are completely missing. Everyone assumes that because the company just delivered a blockbusting earnings report, the stock should be effortlessly gliding toward new all-time highs. Instead, it has slipped roughly 6% over the last week and sits about 10% below its recent peak of $236.54. The unexpected reality here is not that the business is slowing down, but rather that the financial architecture supporting this multi-trillion-dollar valuation is showing signs of extreme concentration. Specifically, a deep dive into their latest regulatory filings shows that just 3 massive customers now account for a staggering 64% of the company's accounts receivable, up from 56% in the previous quarter. This means the world's most valuable silicon giant is becoming dangerously dependent on a tiny handful of buyers, transforming what looks like an unstoppable macro trend into a highly concentrated counterparty risk. When you look at the general consensus surrounding Nvidia stock on major investing sites or the Robinhood app, the narrative is almost entirely focused on unbridled growth. The company reported a historic $81.6 billion in revenue for the first quarter of fiscal 2027, which represents an 85% jump year over year. To put that into perspective for anyone handling an individual brokerage account or adjusting their self-investing strategies, that kind of top-line expansion for a mega-cap asset is practically unheard of. The market expected a strong beat, and technically, Nvidia delivered it, beating Wall Street's revenue forecasts by over $2 billion and posting a non-GAAP earnings per share of $1.87. Management even went structural, multiplying their quarterly cash dividend 25-fold to 25 cents per share and tacking on a massive $80 billion share repurchase authorization to reward those practicing online investing. Yet the stock fell. This creates a fascinating psychological tension for anyone watching the charts on their Interactive Brokers platform or tracking their portfolio on the Fidelity mobile app. The expectation was an immediate breakout. The reality is a classic sell the news reaction, driven by sophisticated institutions rebalancing their risk profiles. To understand why this is happening right now, we have to look closely at the intraday volatility and the massive institutional trading volume shifting behind the scenes. During today's session, the stock fluctuated between an intraday high of $214.15 and a low of $208.78. This churn is a direct reflection of a broader sector momentum shift. Large institutional funds utilizing advanced trading infrastructure like the Interactive Brokers trading desk or Enterprise Fidelity wealth management tools are analyzing the sheer scale of capital Nvidia is locking up. The company's total inventory and forward supply-related commitments have ballooned to approximately $145 billion. That is an enormous amount of capital tied directly to future demand assumptions. In the semiconductor industry, which has historically been defined by brutal cyclical swings of boom and bust, locking up that much capital means management is making a high-stakes bet that the current trajectory will remain perfectly linear for years to come. If demand from those top 3 hyperscalers blinks even for a single quarter, that $145 billion commitment could rapidly transform from an asset into a massive operational anchor, which is exactly why cautious capital is stepping back to evaluate the situation. This intraday pressure isn't happening in a vacuum. It is deeply tied to how investors view online investment opportunities across the entire tech ecosystem. Think about how major platforms treat these massive market cap shifts. Whether you're analyzing tech allocations via Schwab Intelligent Portfolios, tracking Fidelity ETFs, or managing automated tech baskets through a SoFi robo-advisor, the outsized weight of a few select names changes the risk dynamics for everyone. Nvidia stock alone has recently been estimated to command a massive chunk of the S&P 500's net performance. When one stock moves the entire market, institutional desks become highly sensitive to any variable that looks imperfect. Comment below how many shares of Nvidia stock you currently hold in your portfolio, and let me know if you are buying this dip or holding off. Looking at the order flow on the Robinhood stock trading interface, retail demand remains steady, but the institutional side is showing signs of fatigue. This is a classic pattern we have seen over the last year, where the stock experiences a temporary post-earnings hangover as the market digests the sheer scale of the guidance numbers. To put this structural reality in context, it helps to understand exactly what Nvidia does and how its core business model operates. At its heart, the company designs graphics processing units, or GPUs, alongside highly complex software architectures like CUDA that allow these chips to handle massive parallel processing workloads. While they started decades ago dominating the PC gaming space, their true value shifted when corporate data centers realized these chips were uniquely suited for running complex mathematical models and training large-scale artificial intelligence neural networks. Today, their business is split primarily into 2 newly framed reporting platforms, data center and edge computing. The data center division is the absolute crown jewel, accounting for a breathtaking $75.2 billion of the total revenue in the latest quarter alone, up 92%. This is where the hardware transitions from legacy computing into massive modern infrastructure. Their newest architecture, Blackwell, is seeing unprecedented order books, and management is already teasing the upcoming Rubin platform. The strategy is to maintain an aggressive annual product launch cadence, ensuring that customers cannot easily transition to custom in-house silicon designed by competing tech giants or switch allocations to alternative chip makers. However, historical context shows us that maintaining a monopoly-level gross margin of 75% is incredibly difficult over an extended horizon. When you look back at past cycles, competitor entry and customer oversupply have always corrected outsized margins. Right now, major cloud providers are aggressively spending tens of billions of dollars on capital expenditures to build out physical infrastructure. This is what pushed Nvidia's revenue from older baselines of $44 billion a year ago to the $81 billion mark we see today. But the core question for anyone involved in self-investing or building a long-term position through Fidelity Investments is whether this level of corporate spending is sustainable. If cloud companies do not see an immediate, clear return on investment from the software applications built on these chips, they will eventually face immense pressure from their own shareholders to scale back their capital budgets. This potential air pocket in future demand is the exact reality hanging over the stock, contrasting sharply with the retail expectation that the spending boom will simply last forever without disruption. Furthermore, macroeconomic pressures and geopolitical friction are introducing elements of volatility that the market is struggling to price accurately. For instance, data center product shipments to mainland China remain effectively at zero due to stringent export controls, representing a complete pause compared to the $4.6 billion in revenue generated from that region in the same quarter last year. While management has noted that Washington has cleared certain modified chips like the H200 for select entities, Beijing has simultaneously signaled to its domestic firms to prioritize local alternatives. This means a massive, historic $50 billion geographic market is essentially blocked out of Nvidia's immediate forward guidance. Nvidia's Q2 revenue guidance of $91 billion is undeniably massive, but it completely excludes any assumed data center compute revenue from China. If geopolitical tensions ease, that represents a massive latent catalyst. If they worsen, or if domestic alternative chips gain a permanent foothold in Asia, Nvidia faces a structural cap on its global addressable market that no amount of engineering can easily overcome. As we look toward the future outlook, the tension between expectation and reality will continue to dictate the price action for Nvidia stock, as well as peer tech giants like Apple stock or Nvidia stock derivatives. If you are managing your capital through a Robinhood app brokerage or looking for investment help on advanced investing sites, the key is to watch the sovereign demand data and customer concentration metrics rather than just the headline revenue beats. The management team is trying to mitigate their hyperscaler risk by expanding into sovereign infrastructure, which now accounts for over $30 billion of their mix, but that transition takes time. In the near term, the stock is likely to experience continued choppy trading on platforms like SoFi Active Investing or the Interactive Brokers platform as options open interest rebalances. The fundamental business remains incredibly healthy, boasting unprecedented free cash flow generation of $49 billion in a single quarter, but the market has already priced in a near-perfect execution model. To sustain the next major leg upward, reality will not just need to meet the current lofty expectations, it will have to prove that the broader corporate capital expenditure cycle can expand indefinitely without hitting a macroeconomic wall. Disclaimer. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, unshare with your friends, bell subscribe for more updates.